It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital Lending. And joining me today, the man whose name is on the door of the Old Capital Podcast, Mr. Michael Becker. Michael, how are you?
Doing well. How's it going today?
Oh, what day have I been locked in this self-quarantine? Is it day 50, 60? I'm all the days are kind of coming together, but I'm starting to see.
It's funny, they seem to go fast, even though nothing really seems to be accomplished. Kind of all the same, but they all tend to go pretty quick.
Yeah, we were on a call with Greg Wilk last week or 2 weeks ago, and we were trying to say when this whole thing started. And Michael, I think you threw out that it was started when we all realized that Tom Hanks had gotten coronavirus, and he goes, "That's absolutely correct. That's in our minds. That's when this whole thing started to collapse. The economy started to fade away a little bit, based on when Tom Hanks was reported to have the coronavirus."
So I can blame Tom Hanks for my deals falling apart for now until the future, because we had a couple of deals set to close that all blew up. So thanks, Tom Hanks.
Yeah, thanks, Tom Hanks. So in the Ask Mike Mondays episodes, as you know, Michael has kind of a unique background because he was a banker for such a long period of time for one of the largest national banks in the country, kind of ran his division on commercial real estate lending, and then transitioned from being a loaner of money to being an owner of real estate. Him and his group over at SPI over the last 10 years or so, less than that, have purchased over 10,000 apartment units. Now I think you guys are down to right around about 6,000 so. Is that right?
Unfortunately, we own 6,000. It should be closer to 5, but we own 6,000 units as we talk today.
When you say unfortunately, what's the unfortunate part of it? Are they not performing? Or
No. We had about 1,000 units that we were going to get out between March and probably April, May, and unfortunately about 1,000 units that were set to sell. Several, or most of that was in escrow, and one of them was about to call for offers. All that's kind of been put on holds, and it looks like we're going to own those assets for a little bit longer, which, at the end of the world, it's something in the world. At the end of the day, in theory, hopefully our loans will be lower principal balances, and we'll be able to generate some positive cash flow along the way. And ultimately, I think with all the amount of money they're going to print, I think ultimately it's going to create valuations to go up in the long run. So I think we'll probably look back upon this as a blessing instead of a curse. But in the meantime, it was really kind of a downer to have some stuff that you go out, you buy, you renovate, you implement your business plan, you go to market it perfection, you get a good bidding war, you strike a good favorable contract, and then Tom Hanks takes it away from you. So that's basically what happened.
And you guys were all lined up after you were selling that property to buy another one. So as a domino, right. Yeah, that unfortunately
took that one away as well.
Yeah, so that's
fortunately we didn't get into escrow, and we didn't have the $500,000 up hard like we were about to in a few days. So that worked out. At least we didn't get stuck on some hard money. But it was it is what it is. It's just a tough environment for everybody, and I'm sure no one's crying for me. So we can move on to whatever the topic is for the day.
Well, I hope they would cry for me, because I'm looking for 1,000 likes on iTunes. So I'm looking for 5 stars. 5 stars. If you have a chance and if you think that we bring value to the conversation, we'd love for you at some period of time, make a mental note, go back in and give us a 5-star review if you could on the Old Capital Podcast. We certainly would appreciate that. So don't forget that. And also don't forget about the 17-page white paper report on what you should get is Multifamily Financing 101. It was something that James, the Professor Eng, had written with Michael Becker and myself, and it kind of gives you the checklist of what you should be thinking about, why banks ask for the certain things when you're originating a brand new loan. And so you just want to get familiar with your largest partner, which is the lender in the deal, on what they're going to be looking for that you need to provide to get that 65, 75, 80% loan to cost, loan to value in these transactions. So go to the Old Capital Podcast and download that report. That would be great. So as you know, we asked Mike, because he does have a unique position about owning real estate, that we want to kind of figure out how he can help us in operations and workflow and deal flow. And so the question that had come up that I think is important, in your opinion, what asset class is going to take the biggest hit and why? And the asset classes are broken down by A, B, and C. A would probably be a brand new apartment building that was just built or was built a few years ago. A B probably was built about 20 or 25, 30 years ago. It has high amenities and it's in very good shape. A C is kind of workforce housing, a little lower rents, probably could have been around for 35, 40 years, depending on how the upkeep and the quality of the property is. So we kind of rank these in terms of the quality and the amenities of the age of the asset, A, B, and C. So I want to figure out that. And then same question is that, Michael, you've always said, don't buy in the hood. Any additional insights during this time?
Yeah, so I think just to start off on a slight tangent, I think one thing that I think we're gonna, you always have these big milestones in the economy that kind of before or after that kind of separate things. So I think, in Dallas Fort Worth and Texas in general, most of the country, kind of always think of Class C as kind of the 60s and 70s kind of vintage in Texas, and the B's kind of the 80s, and kind of got your 80s vintage, and you got your A minus is kind of the late 90s and maybe the early 2008 kind of that recession, and then kind of the A's been kind of post 2010 and newer kind of product. That's kind of what I always thought. I think when we come out of this, we're probably going to reset that where the new C class, anything built in the 80s will probably be C class. Anything with like 8-foot ceilings will probably be C class coming out of it. Maybe the 60s and 70s will be kind of C minus or D, if we can ever call anything a D again. And then the new B will probably be that kind of 90s to 2008 will probably be the new B class. And then your new A minus will probably be stuff kind of built this cycle, and the brand new A stuff will be kind of stuff built the next cycle. I think that's probably what we're at least what I'm gonna probably think about it. So I think we're all might have to have a little bit different nomenclature on kind of the vintage going forward. So I think this is probably one of those things where we'll see quite a disruption and new supply. It'll take a long time for stuff to kind of turn the spigot back on. So that's just kind of a side tangent. But as far as kind of performance and what I expect or what am I seeing, I think generally speaking, it's still pretty early because we're still kind of in late April as we record this. But you're seeing, kind of what I would expect to be true, where kind of the Class A collections are definitely doing a lot better. Class B is kind of lagging behind that a little bit, and Class C/D is kind of having the most collection issues, and that makes sense because if you look at kind of the job disbursement of your respective tenants or the tenants that demographically make up those A, B, and C, where the A people tend to have a little bit more white collar jobs and potentially can work from their laptop from their house, like Paul and I can. Where if you go into kind of the B and C class, you tend to have a higher propensity of people that work retail jobs, or maybe you're a server or cook at a restaurant that kind of occupy the 60s and 70s vintage deals that litter the Southwest and Southeast parts of the country, and whatever it is in the kind of Northeast. So they tend to be a little bit older, but you get the point where those people have to physically be somewhere to earn an income, and their income's disrupted. So you're tending to have more collection issues. So I think to the extent that as far as kind of operating goes and paying your bills, you're going to have a harder time from collecting your income, at least for the immediate to intermediate term in the workforce housing pool. As far as what does that do going forward on cap rates, we have for years, I've been preaching on the podcast and just kind of my day-to-day life doing business. It just didn't make sense to have the same or very similar cap rates for something built in the 1970s as you can for something built 2-3 years ago, because basically all the cap rates converged in upon themselves. So it just didn't make sense. So for years we were in the process of selling old, buying new, and taking advantage of what I thought was a mistake by the marketplace by not pricing risk properly. And now I think we're seeing the risk that was always there is finally starting to show itself. So I do think that we're going to start seeing a divergence of cap rates where, if the extent cap rates are going to go up, they're going to go up a lot more on the lower end of the range, and they'll be a little bit stickier at the top end of the range. I mentioned on previous podcasts where I think the pain really is going to be in the marketplace will be kind of like a barbell where you get your very, very top of the market's going to have problems, meaning that's a brand new deal currently in lease up or something that's about to deliver and have to lease up. It's going to be pretty challenging to lease some of these deals up, and these lenders or these developers that are on bank construction loans with, short maturities that maybe even have mezzanine financing behind them, have a maturity. Those are going to have more pressure and might sell and temporarily kind of reset some pricing at the top of the market. I think at the very bottom of the market, as you see the cap rates expand, they'll disproportionately expand at a greater pace on the lower end of the market than the upper end of the market. And, I think to the second part of the question, that'll be definitely more felt in high crime, the most lower socioeconomic areas, the areas of the most crime will definitely feel that because the risk has always been there, Paul, and the marketplace covered up for a lot of people buying in the hood and dumping, 6,000-7,000 a unit, regardless of the area's demographics, so to speak locally. So if you're buying in Lake Highlands or Woodhaven in East Fort Worth or some South Dallas or some similar locations to that, I think they're starting to see even more collection issues relative to something South Dallas having more collection issues than something in South Irving, for example, for those people that are familiar with Dallas Fort Worth. And I think that'll be the pain. And then when everything starts turning back on, the first people that go by will be people that kind of pioneering a little bit, and you'd much rather buy something in a much better located deal than something in a high crime area. So the liquidity will be much greater in the lower crime areas, and there'll be very little liquidity in the high crime areas. So if you have a bridge loan in a high crime area, I think, you were crazy 2-3 years ago, and I mentioned that repeatedly on the podcast. I think you're about to feel the pain in the near term. So hopefully you have a long enough loan, low enough leverage, and enough cash reserves to weather the storm is coming your way.
If you have time for one more question, how will make-ready costs in the future be affected by this health crisis? And have you seen any troubles with getting maintenance supplies?
Yeah, I think in the immediate term, we're trying to do our best to just do a basic turn. We're not really doing a whole lot of upgrades because we're not quite sure we can go get. We're not really trying to push rent, so why spend the dollars if you're not going to get the rental income in? So that's the immediate term. We're certainly turning off upgrades, which will reduce the make ready and turnover cost for sure. One, and then two, I think turnover is going to be much lower than what it historically is, which kind of listen with guys like Greg Willett say that everyone's kind of sheltering in place, which means they're just not moving to the same degree that they historically have. So I think you're going to have a lot higher renewal percentages at your properties, which will then further reduce the turnover and make ready costs in the next several months, I would imagine. Then I think kind of longer term, honestly, it might go up, Paul, because I think we've been living in a world of maximum efficiency where global supply chain largely comes over from Asia and China, where a lot of the stuff's made over there. Because you could buy a light fixture for $30, where if it's manufactured in America, it might be $60. So people are going for the more efficient way of doing this. What I think people are starting to realize, and me as part of that, is just because we have an efficient supply chain doesn't mean it's very resilient. So I think we're going to start seeing less as this stuff starts onshoring and disruptions, and God knows what the political ramifications and sanctions and things like that will be once we kind of get on the backside of this virus will be for China. I think we're going to start seeing supply chains disrupted, and stuff like making light fixtures will not be as big a priority as basic medical supplies and drugs and stuff like that. So I think they'll be a little harder to get those things going. So I think it's going to be much, much harder to get, appliances and fixtures and things like that. And at some point, which will start driving, costs of those to go up, which would then make your turnover and make ready costs go up. And, so I think in the kind of intermediate to long term, I think we're going to see inflation in the cost of turnover and make ready, and that'll bleed over into the new construction as well. I think it's going to cost a lot more to build a product in the future than it has in the past. So, I think my general kind of macro take, Paul, something I've said a few times is, I think in the amount of money they're printing with the supply chains kind of being back onshored and a lot of those jobs coming back here, I think everything's going to cost a lot more. So I think we're going to see a lot of inflation, because I've been thinking that for a while, which we've certainly seen inflation in asset prices, but maybe not so much in consumer prices. I think we're going to see both asset and consumer price inflation. And I think somewhere in the next, probably 10 years, I think prices of apartments going to be, double or triple what they are today. And, the question is, can you hang on for the next 12 months to make the next 10 years? That's in my mind. And I think if you can hang on for the next 12 months, I think if you just hang on for 10 years, people are going to make a lot of money.
One of the good things that with all this $22 million in unemployment and all these people that have been stressed out with their jobs and whether they've been landlords of collecting, the one good thing is in the state of Texas, they've opened up the ability to do drive-through alcohol sales.
Yep.
So if you were driving up after you wanted to get your cheeseburger and you were going to go through the drive-through to get your alcoholic beverage, what drink would you want to have, Michael?
The takeaway we've done a few times is when I've actually gotten alcohol, it's been from our local Mexican restaurant. So I'll get a frozen margarita to go. I'm not a big tequila guy, but that's been I've done that a few times and ordered some bottles of wine for my wife from a couple of other restaurants. So it's been good. Hopefully that's something that sticks around on post this. It's kind of silly that you can, if you're taking away food, you can't take away a drink as well. So hopefully that'll be one of the silver linings that come out of this.
Certainly hope so. If folks want to get more information about what SPI does, again, can you explain what you do over at SPI?
Yeah, so I think the best way to find out more information about us is simply go to our company's website, which is www.spiadvisor.com. That's SPI like spy advisor.com. There's a contact us form, fill that out, and we're always happy to send out more information about what we do. And really what we do, Paul, is two things. First and foremost is we focus on putting together high quality deals, and we'll go out and raise capital in the syndicated format to go get these deals together. So hopefully the latter part of 2020, we'll get the spigot turned back on and start doing some deals, because I'm feeling like a little addict here lately, and I got some withdrawal because I'm not doing deals, which is my favorite part of the business. So hopefully we'll get those turned back on and get some high quality opportunities and take a little bit of advantage of maybe some of the disruption on the marketplace. The other thing we do, if you have some money, typically we're focused on people that have kind of $5+ million they're looking to place, and you're sitting on the sidelines wanting to buy multifamily in Texas, and you need something to kind of help you, leverage our relationships experience, track record lending. We can do what we call advisory services, where we can help identify a deal, help underwriting it, put it together, get you set up with a team, place the debt, maybe even stay on and JV the deal with you guys. We're happy to talk to folks that could kind of meet that $5+ million in equity. So if you do, feel free to fill the format. We're happy to set up a call and discuss if that might be a good fit or not.
You guys are very multi-talented, and you guys have had a lot of success on that advisory business. Can you give me just one example? So when people think about the advisory business, I know that you've had many happy clients, but can you just give me one of?
Yeah, the poster child that kind of sticks out really is we had a gentleman that had a couple fourplexes. This happened to be on the oceanfront, Marina Del Rey, California. So he sold both those several years ago. We bought a 100-unit deal. We bought a 188-unit deal, respectively, with the two different fourplexes. And we've gone full cycle on both of those. One of them we then 1031'd into went from 4 units, 100 units to 200 brand new Class A units. So went from basically 4 units that were basically dirt value only, 200 unit brand new Class A deal in Texas in about a 3-year span. So it was a pretty awesome story. Unfortunately for my friend there, the other one he sold, he went and bought a motel with in California and didn't stick with us. So I hope he's going to do okay. But that was I thought it was a little strange at the time, but that's what he chose to do. So hopefully he's
super challenging asset class with the hotel. That's not good. But I think if you pull the curtain back a little bit, he went from making $1,000, $2,000 a month,
feeding
making no money.
Yeah.
Not on the hotel, but on the fourplex.
I was feeding it because it was just, challenging on the ocean. The rent to value ratio was just super out of whack. They're real, kind of dumpy fourplex built in the 60s or whatever. They just happened to be oceanfront. Then he tried to go to do the short-term rentals. And of course, in California, there's a whole bunch of NIMBYism. The neighbors didn't want him to do Airbnb, and became a whole challenging with the local regulations. So he got out of a headache to making, 40,000 a month on that before we turned distributions off a month ago. But that deal's doing fine. So that'll be one of the ones that we'll turn back on, I think, sooner than later.
So that guy should be sending you Omaha steaks once a week or every other day. Or Harry and David, just to keep on your list for the next one, that after he sells that motel or hotel at some period of time, he's going to want to buy an apartment building back with you guys again. So
I would imagine.
Yeah, I think that's great information. So again, is it spiadvisory.com or is it
That's
SPI?
right.
Okay, SPI Advisory. So sounds good. We appreciate your words of wisdom, Michael, always. And I'm Paul Peebles. Have a great day.